YouTube. We're about 5 or 6 minutes away from getting this rodeo going. 6 minutes away from getting this rodeo going. Yeah, quite an echo. We got that fixed. 6 minutes, Bubba. 6. 6 minutes, Bubba. 6. Gotta get a rock star. We'll go in 5. Yeah, very much so. All right, I'll be right back. All right, baby. Are you ready? Welcome. Welcome to the first Traders live stream ever. So cool. So anyways, hey, we got a thing called the FOMC. They are writing their press release right now, and they're going to get ready to release it. Will the Fed raise interest rates? No. Will they cut interest rates? No. So will anything happen at 2? I don't know. But we will find out. And then we'll have a press conference a half an hour after that. And in the press conference, we will find out if they are going to, well, they're not going to directly tell us, but Jay Powell is expected to hint that they will cut interest rates in September. With that being said, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Yeah, baby. Cool, right? Yeah, very cool. So, you know what I could have done? Traders up to now, as it says here, does all the grunt work of technical analysis for you. But soon, Traders will also do your fundamentals for you. And it'll do the training courses, which are all videos, 100 hours. And we're going to have our live performance coaching, all integrated into one platform. Very cool, right? Right now, the stock markets are having a monster day. They're assuming the hints of a cut will be will happen today. And because of that, if you go to your charts, ooh la la, big green on the screen. Yeah. Oh, for sure. So you could go to radar, right? And go to not stocks, but indices. And there's what is happening now in the FTSE, in the DAX, in the Nikkei. Wow. Very cool. Lots of cool stuff going on. Now, if you do trade individual stocks, that's what's happening today. Exxon, Baidu, Netflix, Alibaba, Nike, Pfizer, Moderna, Visa, Intel, Microsoft, okay, Adobe. Cool. That's just page 1. Page 2. Oops, scroll back up. Tesla, Amazon, Meta, Broadcom, Apple. I think we said Pfizer. I mean, cool, right? Oh, that energy drink is so good. Yeah. So big event going on. Volatility expected. Scrolling a lot today. Yeah. Cool. So we're 9 minutes away. How do you feel about that emotionally? Well, I'm giddy. Now, since this is the inaugural Tradar's live stream, would you be so kind to subscribe and click the thumbs up button? I'd appreciate that. Now, if you have any pressing needs about FOMC, the Federal Reserve, monetary policy, so on and so forth, like I said, I'm integrating everything from Investor Bootcamp. And this is not available quite yet, but it's being integrated into Tradar's. And I'm following the layout as best I could, but I found the organizing all the courses made sense on the left. And then you'll be able to either quickly see what's going on in the community. So I posted a chart and made it responded. Okay. And we could have a quick Facebook-style stream there, or a massive full community when you click on here. I'm not going to do it right this second. You can see I'm still building it, but it does work. And when you do that, over there, we're going to have challenges like homework challenges and discussions and Q&A and support if you need support with the traders community, and a book club and movie night and all kinds of really amazing things, and support groups in the sense that outside of the staff and the coaching, community leaders can establish things like either an impromptu, like let me help you personally, or let's talk about this topic as a group, or just a support group to just talk about anything. It's all happening. So community leaders can just pop up a Zoom type room, but it's all built inside of our community just for our members, and have it and record it and all that kind of stuff. RSVP for it. Very, 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 very cool stuff. Okay. Well, no, Bern. The 1-to-1 would be the scalp, right? The scalp on the on the main page, right, in the scalper, but it's just a scalp. I don't like those trades because they're 90% done, but they've been triple confirmed. Well, if you want triple confirmed, there's no you're eating chicken wings. You're not eating T-bone steaks, right? So I get it. So you're right. So a lot of the things are 1-to-1. Also, if you're talking about radars in this one, it's only the first leg. It's not telling you the value of the trade. It's telling you the next leg. No. Hang on. Let me finish this and then we'll come back to that. So, for example, when I launch this and you want more information about, the FOMC and the Fed, well, that would be here. So you click on that and you get to the Central Banking Fundamentals course, and here's all the lessons. Beautiful, right? It's beautiful, right? Yeah, it is beautiful. And so you can go here.
Create the money. So it's really the banks, through the manipulation by the Fed, through this reserve, this fractional reserve banking system. And all that means is that depositors put money into a bank. Banks are required to keep a fraction of it.
So this has changed, by the way.
In case someone shows up and asks for some of their money back, they take the large.
So anyways, you'll be able to get all that information. You want to learn about macroeconomics? We have a whole course on that. Beautiful, right? Extraordinary. Gorgeous. Lovely to the mum. Okay? So all that's been built and will be released September 1st. Now let me go back to the question about risk reward. It's a great question, Bern. It's perfectly fine. Yeah. And I do believe I know what you're saying. So you're like, well, you're risking this for that. You're risking this for that. You're risking this for that. Now, first of all, they're not trade recommendations, so you have to understand that. So if it was a trade recommendation, you'd be worried about risk reward. Well, if it's not a trade recommendation, what is it doing? It's telling you the next leg. So, for example, the USD ZAR is a down channel. You don't buy down channels, ever. Okay? So imagine it like all it's telling you is the next leg in the move. So what you want to do is let it go up and then dump it. You see? And once again, it's not thinking risk reward either. But what is likely to happen is down, up, down, up, down, right? So it's just recognizing the pattern and showing you the next leg in the pattern. It's not a trade recommendation per se. Okay? So when you're inside of a channel, let's say by most definitions, there will always be equidistant or nearly equidistant. So you'll always have a 1-to-1, but that's not what it's saying. You could make the determination depending on how bearish you are, or on the bigger time frame how big the bearish move you think will be, and you could sell it there and probably hold it, on a move like this. It's just the next leg is from the bottom to the top, and then the top to the bottom. That's the pattern. That's it. Will it have a good risk reward ratio? Well, that's for you're the one that does that analysis and determination. Okay, so we're about 2 minutes away. Does that make sense, Bernd? I think it does. Right? It's just doing the technical analysis of that pattern, of that particular channel. If we were breaking out of an area, a triangle is broken, you should need to know. It doesn't mean buy, and it doesn't mean if it goes up that's the end. Okay? What it's doing is determining the distance from here to here and then plotting that from the break up and saying, well, there you go. It's just that's how you trade that. but that may not be a good trade. That's why you need the fundamentals. So let's get over to the news. Okay. And I'm going to play a squawk for you for now. Hey, did you click the thumbs up button? Right? That 1,000 pip trade I made on pound yen was recommended by TradeRs, but it didn't tell me it was going to be 1,000 pips. That was me.
And a minute now until the top of the hour. Look out for the FOMC rate decision, where the central bank is expected to hold rates 5.25 to 5.5%. Of course, we'll lead with the rate decision and thereafter go through the accompanying statement.
Well, it's the pattern. It's describing the pattern. It's the failure of the pattern and the fruition of the next wave of the pattern. So don't worry, I'm going to do a whole training course on all of that.
10 seconds.
Here we go. Are you guys excited? No change.
That is unchanged as expected. Unchanged as expected. The Fed does note it's attentive to risk on both sides of the dual mandate. A change from June when it said it was highly attentive to inflation risks. Says in recent months there has been some further progress to the 2% inflation goal. And in June it said there had been modest further progress. It says it's attentive to risks, as mentioned, and also risk to achieving employment and inflation goals continue to move into a better balance. That's a change from June's towards better balance description. It notes the economy continues to expand at a solid pace and job gains have moderated. Unemployment rate has moved up but remains low. And it repeats it does not expect it will be appropriate to lower rates until it has gained greater confidence inflation is moving sustainably towards 2%. It does note the vote in favour of the policy was unanimous and the economy continues to expand at that solid pace.
Okay, let me turn the squawk off. Cool. All right. Oh. Economic activity has continued to expand. That's not good if you're going to cut interest rate. Job gains have moderated. Okay. And the unemployment moved up. Okay, now you can cut. But it still remains low. Okay, now you can't cut. Inflation has eased over the past year. Okay, you can cut. But remains somewhat elevated in recent months. Now you can't cut. There has been some future progress towards the committee's 2% inflation. Okay, great. Then they say their goals. They always do this in the second paragraph. Whatever. In support of its goals, the committee decided to maintain the target rate. Committee will carefully assess. The committee does not expect it will be appropriate to reduce the target rate until it has gained greater confidence that inflation. Having read a lot of the reports personally, I've noticed there's a lot of language in there to say they're not really ready to cut interest rates in September. And when I look at that, that's not a hint that they want to. So, we knew it would come down to the press conference. And probably very few people actually read even this announcement, which shocks me, but now I'm not shocked about almost anything anymore. But look at what they said over and over again is they're making progress, but it's still not good. You notice that in the first first paragraph? Okay. Economic activity is expanding. We have job gains. Okay. We're at or near full employment. Inflation remains somewhat elevated. And it's, right? Yeah. So anyway, so there's a lot of like, things are not as bad, but they're not there yet. And then we get to this sentence. The committee does not expect. Are they talking about now? Expect is kind of future looking, isn't it? The community does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation, they didn't say anything about employment, is moving sustainably toward 2%. Well, that doesn't sound confident for September, does it? Oh, sorry. I didn't see it over there. All right. Interesting, huh? So we can very quickly like take a look at things like they said unemployment is still quite low. We can go check that. We can go to employment, in this case, the unemployment rate. And we can go back, let's go back 5 years. Okay, over 5 years, the average is included is 3.8, and we're still well above 3.8. Or no, I mean we have moved above 3.8, but it doesn't look crazy out of control, right? I guess is what they're saying. Maybe we can add a few more years. I'm not sure how many years we have on this, by the way. There it is. Well, we got at least 8 years. So we're about average over the last 8 years. Let's see if we can add 2 more years and get the last decade worth of non-farm payrolls data. All right, so we are actually below average for the last 10 years. Interesting, huh? Let's see if we got 15 years. Let's go back to the great financial crisis, which, no. All right, so we can go back to 2014. So we have 10 years. Okay, let's pull it back. Good to know, right? 10 years of data. That ain't bad. And over those 10 years, 4.3 is the average. We're 1? Yeah, 4.1. The median average, 4.3. Cool. So we're not like out of control right now, the economy, right? And that's what the Fed says. Like, look, we're not up here at 14% anymore. We're back to 4%. And that ain't bad. You might want to think like whatever was before this made the Fed cut interest rates. Yeah. And at this point, it doesn't seem nearly that high. Even here, it was 6. I think it was higher before. Actually, not on 14, though. But anyways, look, it ain't crazy is what I'm saying. The economy is not in dire straits, but that's not where we are anyway. So the Fed is normalizing interest rates. So normally, the Fed funds rate would be, let's say, 1% higher than inflation. So if we have 3% inflation, which I think we will for a very long time, we would have 4% interest rates, Fed funds rates. We would have 5.25% mortgages. Or let's just keep the same. We'd have 5% mortgages, 4% Fed funds rate, 3% inflation. And that'd probably just be fine. So we can take a look at like yields, for example. Here we go. Hot money. Yields are consistently falling, which in a way implies that investors in short-term government treasuries, what I call hot money traders believe the Fed's going to cut interest rates. And you could say right now it's implied that we're going to, let's say, the 8-day average is about 4.5, but we're at 4.35 and falling. Again, you could imply, this is not, a government rule. This isn't law. It's not, God handing you the future on a platter. But you could look at this and say, in 2 years, interest rates are going to be on the way to 4.5 to 4.25. And that's being priced in right now. So, look, this has been going on since May. Do you know what I did here? I bought treasuries, which is the equivalent of saying yields are going to fall. Now, why does that even work that way? Okay, so let's say you bought a 2-year treasury today and I bought one here. Mine pays me 5%. Yours pays you 4.25. Mine pays me 5. Which one has more value? The one that pays me 5% or the one that pays me 4.33%? Well, of course, the one that pays more income. It's like, which apartment building is worth more? The one with $1,000 rents or the one with $3,000 rents? Well, probably the one with $3,000 rents, right? So anyways, mine's just worth more. So since this period, the value of my assets went up. Now, does anyone know or understand or can do the math for bond convexity? It's a good way. It's a good icebreaker at a singles bar. Hey, baby, I know bond yield convexity. Here's what that means. Okay, if the 2-year drops, okay, from 5 all the way down to 4.33. But you're in this investment for 2 years. How much money do you actually lose? It'd be hardly anything because it's just over the course of 2 years. It's not a radical change. Okay? And it's over a short period of time. So you're not going to be fraught with angst because, well, it's mostly just due to the short amount of time. So ultimately, your absolute loss is very little, is what I'm trying to say. Now, what if, okay, let's reverse this. What if you have a variable mortgage for 30 years? So you're a European. This is a really bad deal. I don't like this at all. But you're in a 30-year mortgage and your percentage is variable, right? Okay. Let's say, should we make it no, I'm not going to do that. Let me back up. Okay. You're in a 30-year mortgage and I pay 30% on my 30-year. Oops, I should do it this way. I pay 30%. Or 3%, I should say. I pay 30% of, let's say, $1 million. Okay? $1 million. Boop, 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 boop. That's the principal. Okay. And you can pull out a calculator and figure this out. Okay? And let's say you buy, should I make it dramatic like you buy a house in the middle of COVID? No. Let's say you buy a house today. What's your mortgage? It's like 7. You will get a tiny house compared to mine for the same amount of money. So $1 million house, 20% down, 800,000. You're going to pay 4,000. You're going to pay $3,200 a month. Am I right? Okay. $1 million a month. $1 million, 30 years, 7. 20% down, 8. Yeah, you're going to pay, gee whiz, you're going to pay $7,800 a month for the same house. Doesn't matter. Well, you're like, yeah, well, there's a big difference. Okay, then let's think about this. Change the variables. If you have a calculator on the internet, you change it. The difference between 4% and 3%. Let's try to calculate that. It's probably let's say it's $3,700 a month. Okay? $6,000 a year. The difference is $500, right? Times 12 months gives you $6,000 a year times 30 years. Okay, you see? So if we had a 2-year, what's the difference? 12 grand. If it shifted, right? Oh my God. Well, now, what's the difference? Well, 10 years is 60. 20 years is 120. It's 180,000. Okay? The difference between 2 years and 30 years. It's a big deal, right? What I'm trying to say is this tells you where interest rates might be over the next 2 years. Let's say you can use that as a substitute. But I bought 20-year notes because they're going to be more sensitive to these changes. So when the Fed goes from 5.5 to 4.0 over the next 18 months or 24 months, I'm going to do very well because that's a pretty big move. Okay? Yields will fall, and I'm collecting 5.0 on that, right? And it's going to go up. The price is going to go up because it's paying a lot more. Okay. Now, oddly, the 20-year is paying less than the Fed funds rate. I know. Well, that just shows it's unnatural. The market we're in is unnatural. It's manipulated by the government. Okay? And oddly enough, the food you eat, the clothes you buy, the things you watch on TV, the music you listen to is all controlled by somebody. Value of your money, whether you buy a house this year or not, will come down to the government. If they raise, you don't do it. If they cut, you do it. And then we just stumble through life being controlled by the robots now. Yeah. Scary, I think, actually. So I try to unplug as much as possible. I just plug my computer in and the rest unplugged, right? Unplugged. So now let's take a look. We've had a little bit of time. Yeah, burned. Yeah, but are you the one controlling it? Yeah. Yeah, Bern, I can't wait for us to meet up and have cocktails. I got to get to Jim first, though. Jim, I tell you, I had a dream just the other day where I just bought a car, and I'm like, that's it. I remember in the dream, I say to my wife and kids, that's it. I have to go buy Jim a drink. And that's it, really, honestly. And I'm like, pointed my car north. And the funny thing is, I didn't have my Cayenne. I had my Panamera Turbo. So I guess I want to buy that car and come visit you and have a cocktail. Hope you don't mind me smoking cigars. And then I got to go find Burned. But I'm not sure I can get there in a Panamera Turbo. I might have to take a plane or train or automobile, a boat. But anyways, we get here. 100% chance. Well, hell's bells, because we already know. All right, cool. So what are the chances they're going to cut in SEP? Okay, 93.5. All right. Okay. 1 day ago it was 86. 1 week ago it was 90. 1 month ago it was 58. So, spiked today, huh? It's gone up since yesterday. Well, we'll have to see. I'm telling you, look, if I'm an outlier, it's not because of for the sake of being an outlier. And I don't like being an outlier because I'm trying to figure out what everyone else is doing. But I read the reports. And if you want to read the reports with me, we do it at Investor Bank Boot Camp, soon to be part of TradeRs. In the Swing Trading Group, soon to be part of TradeRs. We download the economic reports right from the government agencies, and I read it word for word, and I discuss things out loud. I say that because I don't know, I want to have some credibility here where I don't really have some opinion because I watched Joe Rogan's Experience, or CNBC or Fox. I talk to liberals who listen to CNBC. I talk to conservatives that listen to Fox, and they're both nuts. So I do unplug myself. I just read the reports. And let me tell you what's in the reports. It's not that clear that they're going to cut. I'm telling you, just like the statement we just read, it seemed more of an out of that decision than an in. They're like, we're not quite there. So I'm not ready to declare that these guys are wrong. I'm just not that confident. I don't make the decision, and I will do what the market's doing. But I have to be ready for the fact that maybe these jerks are wrong. And I tell you, in January and February, remember there was a 96, maybe even a 98% chance. Does anybody remember this? Maybe not. There was a time when it was like 98% chance of a rate cut. And I went on and on and on how they're dumb. And that was stupid. And I can't find any evidence of such a thing. And then, in fact, 3 cuts were priced in. And I'm like, there's just no way. Absolutely zero chance. And that the 98% of the market is just flat out wrong. And not because I'm an arrogant jerk, which I probably am, but because I've done the research and I don't see any evidence to support it. Okay? Huh. But I'm not that bold on this one. Like, they really could if they wanted to. And it could be political pressure. It could just be like, look, they're not raising and cutting interest rates, really. We're doing something called normalization. So even if they drop it to 4, if inflation's at 3, it's restrictive. If GDP is less than 3, it's restrictive. So another way of thinking of it is, having the Fed funds rate, let's say a little higher than GDP, is okay. We're printing practically a 3.0 now. So being at 5.5 on interest rates, that is really high. We're at a 3 handle on our way to a 2 handle, really a 2 handle, I guess you could say, for CPI, PCE, real, core, whatever your measure. We're in the 2 handle or very close to it, so we don't need to be at 5.5% interest rates, right? So even if we're not quite there, and that's what the Fed is telling us, they could do it. Okay. Now, I said there was no way they would cut interest rates early in the year, but they could do it in March, and then of course they never did, right? And so I laid it out. I don't remember to whom. Did I do a second half outlook? I don't think I had time this summer. I didn't do a second half outlook. But I still sort of have this idea of cut, pause, cut, pause, cut, pause, cut, pause, cut, pause, done. Yeah. And even then, it would still be restrictive. So it gives a year and a half to get inflation down. I don't think we're going to get it. I don't think we're going to get to 2.0. I think to get to 2.0, the Fed or the government, really, so it's not the Fed, the government would have to capitulate. So the Fed talks to the government and says, hey, you guys calculate CPI, right? And they're like, yeah. And in that calculation, you're including owner equivalent rent, right? Yeah. And that price is just not coming down. It's going to stay high and over time go higher, but it's certainly not going to drop 10%. Is that correct? They're like, yeah, that is correct. There's no way there's going to be a significant drop. In fact, there's probably going to be no drop in rent, and it will go up. Well, government agency, says the Fed, you're preventing the Fed from hitting its target. So we would like you to not use that calculation. And they take it out. They change the math of the CPI. And guess what? CPI, or maybe just in PCE, okay, comes down and the Fed hits the target. But the fact is, housing prices are not going to fall at all. They're going to go up 20%. As soon as the Fed starts cutting, my net worth will go up 20%, or a lot, let's just say. Yeah. Yeah. Cray, right? Let's see the coverage on the squawk. I don't know what kind of coverage this group does. Press conference should be starting in under a minute. I don't think the press conference is even on sonars. No, it wouldn't be.
Just making you aware, Fed Chair Powell has begun his press conference.
That would be dollar strength, though, Joe.
Just initial remarks here from Powell. He does just note the labour market has come into better balance.
I'll let him do the speech. I just want to see what these guys do on the squawk, and then I'll go over to YouTube and I'll pull up the Q&A part, okay?
And you just note they are maintaining their restrictive stance.
We'll get that teed up. He's just going to basically repeat the statement, right? Again, I'm just listening to the squawk, and then I'll zip over. Because I got this pretty toy.
And just making you aware, Powell's obviously continuing to read his speech at the start. He does just note the growth of consumer spending remains solid, but has slowed. In the housing sector, investment has stalled in Q2.
Stock market's going up because remember, 94% of the market believes the Fed's going to cut. We saw it here. Stock market's going up. My net worth is going up. That's why you want to be an owner. Trading is okay. It's good. Investing's good too. You want to do both, really. Thing is, trading, you got to work for your money. Investing, you make money while you sleep.
And continue here from Power News pre-marked text. Does note they suggest labour market has returned to where it was on the eve of the pandemic, and the broad set of labour market indicators show that it is strong but not overheated, and remains somewhat above the 2% goal. And longer term inflation expectations, they do appear well anchored.
Would you like something like this integrated into TradeRs, where you log into TradeRs and we'd have a cool sort of a news feed page like this, and a asset and the squawk, and on top of that maybe some risk gauges to show things changing? Would you be into that?
And further here from Power, just note, as labour market has cooled, inflation has declined and risks have continued to move into better balance, and they are attentive to risks on both sides of the mandate.
Of the mandate. I know he's faking that accent. He's Detroit, right? Like Madonna. Madonna's from Detroit, and she has an English accent for some reason. Oh, it's not fitting the whole screen on for you guys. Oh, yeah. Okay, let's do the Q&A. I'm going to turn the squawky off. Goodbye, squawky. Thank you, new squawk. And let's get on with it. Hang on now. Hang on.
Policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range,
Oh, sorry, I thought he was done.
the committee
All right,
will
we're
carefully
good.
assess incoming data, the evolving outlook,
It's quiet,
and the
huh?
balance of risks.
That's full blast.
As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals.
That's
If the economy remains solid and inflation persists, we can maintain the current target
yeah, I
range
can
for
turn
the
up
federal
your
funds rate
volume
as long as
slightly, but it's not
appropriate.
going to make much difference
If
because
the
it's
labor
quiet
market
for
were
me.
to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable
it's way
prices.
off.
We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina. Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Yeah, they're just not ready. Thanks for nothing.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent.
Is it
with
hard
its
for you
current
guys to
condition,
hear?
I would think that
Maybe I'll just turn them
a
on.
rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation,
No, it's
disappointing
full
readings,
board.
we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be
I turned it up on my speaker.
employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby. Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting.
Yay!
I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
I don't know how I want to do all this.
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the
Doesn't make a
labor
difference,
market
really.
conditions quite closely,
They change the
and
logos.
that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know.
Yeah.
The labor
He's
market.
talking about GDP, by the way.
Maximum employment is one, and stable prices is another. So we weigh those 2 things equally under the law. when we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was, you know, a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be, you know, a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think inflation was actually, core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent, if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of,
I guess I got some ad space
I don't
up
think of it
here,
that way.
huh?
I think of it as, you know, we're actually in a good place here. We're balancing these two risks of, you know, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve.
Steve Leisman, CNBC. Mr. Chairman.
Steve's good.
Back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now of thinking that rates need to be normalized here? Thank you.
Good. See, it's a good question.
Yeah, I can't really say that, honestly. We've seen significant movement in the labor market, and we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting, and if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, as I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions.
We
On
good?
inflation, do the past
34
few
minutes
months of
ago.
good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but it's also...
By the way, do you know I can email you about 12 of these
non-housing
every
services
morning
and
for
housing services. So,
$19 a month?
so the thing is, you've got 1/4 of that. We had 7 months of
Some
of
Forex, some
inflation.
crypto,
You
some
got 1/4
stocks,
of
some
this. I would say the
commodities, some
quality
stock
of this
indices.
is higher, and it's good, but so far it's only 1/4. So I think
Less than
we
$1 a
need to see
day.
more to know that we're, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report, and frankly, the softening in the labor market conditions, give you more confidence that
that?
the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy
That's
that's
interesting.
normalizing.
That's not related to
If we
this,
think
by the
about
way.
the first couple of months of the year, is there any sense now that they were these blips
There
that
it
could have
is. The
actually
other server
allowed
was
for
down for a
earlier
second.
rate cuts,
Huh.
as were some of the projections going into
So
2024?
the thing about if what it is seasonality, and it could just
See?
be, it's very, very hard to do appropriate seasonal
61
adjustments.
cents
If
a day.
that's what it is, then that actually implies that other months were reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We
Wow, look
12
at
months
the
because that
Dow just
takes all that
crushing
out,
it.
all those effects out. 12-month now is 2.5% headline, 2.6% core. This is
Less so
much better than where we were a year
You're
ago. Just a lot
blocking it.
better.
Clear your
The job
cookies.
is not done.
No,
I
no,
wanna
it's not
stress that, and
cookies.
we're committed to getting
Clear your
inflation
cash.
sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are?
Mike McKee's
the
good too,
damage
by
that
the way.
higher interest rates do to
Oh
the
my God, there's
economy
practically
in
a
slowing
tornado
demand and
outside
raising
right now.
prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do
it's
to the
really
American
funny.
people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off. Now,
So that's not correct.
And the
I'm
labor
right
market
here.
has softened. You know,
I'm right there.
probably
See?
the inflation.
Look at that.
Inflation is probably a little farther from its
just
target
me.
than is the employment, but I think the downside risks to the employment mandate are real now. So
I'm
we
right
have to
in the
weigh
middle
all
of
that.
this.
And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year, and the time is coming, as other central banks around the world are facing the same question. The
This is
time
great,
is coming
though.
at
Look at
which
the
it will
markets.
begin to be
Crushing it.
appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So you know, we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just it, and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
It's good. July started
Thank you, Mr.
slow.
Chairman. Edward Lawrence, Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, you know, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So you know, but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports, last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, you know, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got another quarter that is good, and you know, we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin.
Okay, what do you think?
dial
Are we
back
going to get a
restriction.
little role
We're
reversal
not
here?
quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But you know, there was a real discussion back and forth.
Tornado's over.
What the case would be for moving at this meeting. You know, a strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, I mean, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see And look at inflation. Rate sensitive.
Yeah, buck 20. He's talking about the
percent
buck
spending. We
22
really do see
on
now that
ADP.
Policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. I mean, just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guida with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. If it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many
did you guys subscribe?
Rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amir.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with
good move
with businesses and business leaders and workers
Well
and
played, sir.
people in non-private sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or a really bad economy. It's one of there are spots of weakness and there are regions where growth is stronger than other regions. But overall, it's again look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter. So it's just hard to measure economic activity. There are it's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary, but we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook.
OG, you could, but I don't recommend
the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically have our forecast. We can run simulations of.
See, he's not giving a clear
we would
signal.
Never try to make policy
I'm
decisions
not sure they're going to go
based
on
the
September.
outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that they're
Let's go see if this
their
is playing
positions are
out,
given
Kat.
serious consideration. For most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents.
So it's noticed this move in the daily, creating a 15-minute down channel.
We felt more united because
noticed
we
this
felt, under a lot of
24
pressure
minutes
to
ago.
get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
I would dissent. I don't know. I wouldn't dissent
Hello,
maybe in
Jean
this
Young
case,
with
but
M&I
I would
Market
do it.
News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Hi, did you see there was like 3% of the people betting on that? Wrong.
Today.
Thank you, Chair Bell. Jennifer Schonberger.
So you see where we are here?
Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color
138.
on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up.
So it's taking
the first day, there's a discussion of financial stability because it's
Here to
every
here.
other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning, we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And,
That's how I
and
would
there's a
draw it.
range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous.
Yeah, but Bernd, I don't
decision, and
counter-trend
at the
ever,
end,
so
everyone's-
that's not what they
everyone
mean for
supported
me,
the
right?
outcome, not just the voters, but everyone.
You're
So
right.
I would also
But
say.
I think this is gonna
some
fall
people examine
forever.
The possibility, the case for
Until it
moving
doesn't.
at this meeting, but overwhelmingly, the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how.
Sure,
the-
Eskimo, we're a
But
long
there
ways
is a
from
growing
that.
sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question, that is the case. That
Oh!
as I mentioned, we think that the time is it's approaching.
Oh.
And if we do get the data that we hope we get, then a reduction in our policy
Oh.
rate could be on the table at the September meeting.
So yeah, okay.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said,
She's
quote,
so funny.
"It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can we had a lot of advice to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And
yeah, so
have
maybe
the chances
Eskimo,
of a
huh?
hard landing increased?
We have 1,
So
2, 3, 4 months
I don't
up.
know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market, so that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Greg.
Stock market's doing beautiful
Thank you
today. I
so
hope it
much.
sticks and closes high.
In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that
Now
they
that's
really don't
funny,
have
a joke
sense
on
of
his joke.
What is going to judge, maybe not the first cut, but the pace of the cuts going forward? They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
Yeah, I mean,
By the way, thank you very much for being here. I
I
appreciate
think
you.
the reality is that
I think it's really cool that we can do this
forecasters, and
together.
This isn't just the Fed by any means. Forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we have to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks. But nobody has great vision deep into the future. In terms of
Okay,
reaction function,
moment of
that's
truth
that's
to
a
get
long
through this,
time, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So
Muy caliente.
More broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. The
World Bank is leading
to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road, but we don't have, on a CBDC, we don't have any plan to.
All right, he's talking about crap I don't care about. All right. All right, let's answer. By the way, do you want me to stay and answer questions? I'm happy to do it. So, Angel, he says, hey, Wayne, I don't get it. Job loss, less money for the people. What? See, Angel cares about the people. Hey, he's a kind heart. Right? Is it's better for the economy. No, it's not. Okay? All right. Let's say we had the central government give everybody in America $10,000. That's good, right? No, nothing happened. Except we have inflation. So inflation goes up. But the thing is, inflation stays persistent. So after 2 or 3 or 4 or 5 years, inflation continues to go up, but you've spent your $10,000. Okay? More money for the people is the direct path to poverty. Okay? It's the absolute worst thing. Yeah, by the way, good call, Bern. Yeah, I didn't hear owner equivalent rent. You're right. But anyways, Angel, what is good for the people is productivity. Okay. The second part of your question is implied here, and it's sort of like, so what's going on? Well, it has to do with the distance between the current Fed funds rate and the level of inflation and productivity. So like productivity is good, inflation is bad, they can kind of eat into each other. But there's a normal level and then there's an abnormal level. Abnormally low Fed funds rate makes money cheap. So people borrow a lot of money. No, that's not necessarily good, but the thing is, there's a trade-off. See, if you leave your money in the bank, you're not, when those rates are low, there's no incentive at all to keep the money in the bank. For example, you were not really in the market for a Tempur-Pedic mattress, but Tempur-Pedic puts them on sale. And you're like, oh, well, maybe it is time to get a new bed. And those Tempur-Pedics are supposed to be nice. So you go in and you lay on them and you're like, damn, boy, this is nice. How much is it? $3,000. Oh, $3,000 for a mattress. Oh, but we will loan you the money at 0% interest for 5 years. Oh, really? Yeah, and your payments will work out to $22 each. Oh, well, hell's bells. Yeah, I'll do it. And now you bought a bed. Well, if it was 25%, because you had to put it on your credit card, oh, no. And by the time you pay it off at 25%, in 5 years, you'll end up paying $7,000 for your $3,000 bed. And you're like, no, I can't afford it. So there's this like relationship. When interest rates are low, it's cheap to borrow, but you're not earning interest in your bank. Then later on, because of this cheap borrowing of money, you get inflation. Now, there's two things going on. You get no return by keeping it in the bank, but the more you hold onto your money, the less your money's worth, because the $3,000 bed is now $4,000. Well, hell's bells, you should have bought it last year. Now, did the bed change? No. Did the value of your money fall? Yes. How do we express that? When there's one currency versus one currency. In euro dollar, if there's inflation in the United States, so we express it by euro dollar going up. But if it's just dollar over dollar, then the price of the bed went up. Or the price of a barrel of oil went up, but nothing changed in oil. It was just the dollar bought less oil. The dollar bought less bed. So you're incentivized to not save it, and instead you're incentivized to convert it. Okay? So you take it out of the bank and you spend it. Now, this idea of you get two classes. Well, a rich person already has a Tempur-Pedic bed. They already have a 65-inch 4K TV. They already have a nice car. They already live in a nice neighborhood. So if you're not you're not incentivized to save your money in a bank. You're incentivized to buy real estate because you can borrow money cheap. You're incentivized to get in the stock market because their borrowing costs are cheap. Therefore, their profitability goes up. Therefore, the value of that goes up. So rich people get richer when the Fed cuts interest rates. Poor people go out and buy a TV, which is the dumbest thing you could do. But what can I say? Or they go out and borrow money to buy a used car at 14%, and they don't realize it because they buy the car, and the car dealer says, well, you can get this for, $450 a month. And you're like, oh, I can afford $450 a month for 70 months for a car that's already old. Like, all of a sudden you're like, bad deal, dude. Bad deal. Bad deal. So what happens is those the haves do better because they end up making money. The government and the central bank saves them. Now, is that the point? Does Jay Powell hate poor people? God dang poor people. No, it has nothing to do with that. There's a choice that could be made. You can move from poverty to wealth. I'm going to write a book about it, okay? But you have to make different choices. Right now, we have a lot of Americans going on vacation, putting it on their credit card. Dumb. Well, I don't have any money to go on vacation, so I have to put it on my credit card. Dumb. Okay? Thumbs down. Like, just no. You need to break out of the poverty trap, right? So the flip side, you said, so job loss. Well, the issue right now is we have inflation. So why kill the jobs? There are two things that are holding up inflation. Once again, I know this because I actually read the reports. There's only inflation in two areas of the economy right now. And I told you about it 3-4 years ago, whenever COVID was. 4 years ago? 5 years ago. Anyways, we talked about this 4 or 5 years ago. I don't know. In something called Off the Charts with Wayne McDonald. In fact, it might have been the very first one. And in that one, we drank whiskey, I smoked a cigar, and I read Barron's magazine. And we were in the worst part of COVID. This is why we did this. I wanted to do something special. And so we got together, and I explained, first of all, we're never going to go back to the old. We're never going to go back to low interest rates. And that 4%, 4.5% will be full employment. So going to like 4.5% unemployment will be normal and good. Okay? But and we will never hit 2%. The Fed's target, we're never going to hit that again unless you manipulate the numbers. So why will we never go back again? Okay? Wages. It was a bad idea to raise people's salaries because there was inflation. That's the dumbest thing to do. It's the worst case scenario. But most people are not economists. Now, Angel, being a kind person, would say, well, people needed the money, so you should give it to them. No, you should help them. There's a difference. Okay? So, wages are too high, and this is creating what is called, you have a virtuous cycle and a vicious cycle. This is a vicious cycle where you give more money to people because they have inflation, and because of inflation they need more money, and because of that you get more inflation. It's like giving somebody lung cancer a cigarette. Well, they need the cigarette. They're begging for the cigarette. They must smoke. But they have lung cancer, bro. Okay, there's a different, right? There's a different methodology that should be done. So in this case, if we trim some of the jobs, wages will come down and normalize. Right now, we know from reading the reports, wages are up and disposable income is upper. Think about that. Wages are up and people have even more disposable income than before. What does that mean? Inflation has normalized, but people got these big raises. Now they have excess money, so they go out and buy stuff, and because it's free money, they pay the higher price, and inflation goes up. So in 6 months, a year, 2 years, they go back to the boss, I need more money. And then inflation goes up because of an excess in disposable income, and then they ask for more money, wages go up, then disposable income goes up, and inflation. And what happens is the only people benefiting this is rich people. So if think of it this way, if everybody suddenly, if middle America, working class America, suddenly had more money, because you're right, because prices normalized, but they had this extra money, where does the money go? Well, you go to Amazon.com and you buy something, right? Okay, cool. So there's a division of the money. Somebody sold you a product, so you bought a TV. Let's say it's Samsung. Or you bought a phone, Samsung. Great. It goes to South Korea. You just shorted the dollar. But where else did the money go? Jeff Bezos. Do you see? Jeff Bezos made billions of dollars. Like, I think he made $5 billion personally in 1 week because of the money the government gave people in the United States. I want you to really think about that. So if people went out, and let's say people that don't have a lot of assets, they don't have a lot of income, they don't have a lot of savings, but they got $5,000 from the government, they went out and they spent it the way they want. Now they have a 5-year-old laptop. Jeff Bezos has a bigger boat. Okay, they went to Applebee's. I know this for sure. A very large percent of the money went to alcohol and beverages. So they went to Applebee's and had dinner and a cocktail with a mask on. Okay, great. Who owns Applebee's? I don't know who owns Applebee's, but that person's richer, and the person that ate the chef's special of the day has consumed it, and it's gone forever. Meanwhile, Applebee's, it goes somewhere. Okay, the money goes somewhere to the owners. So all it is on hell is, you need to become an owner as soon as possible. Not you, but everybody you. You just have to understand there is a game there. There are rules. These are all opportunities. Okay? These are all opportunities. So you got to kind of be there, right? Yeah. So there's wage inflation, okay? And then there's rent inflation. These things are sticky. This is what I was talking about 5 years ago. These are not likely to come down. Wages and rents. So again, if you don't have many assets, either you're poor or you're young. Okay? Then you rent an apartment. Where does the rent go? Landlord. Okay? But if rents are going up, it means property values are going up. Okay? I own property. Yeah. Guess what? when the Fed cuts interest rates, more people are going to be able to access mortgages because they can't afford a 7% mortgage, but they can afford a 5% mortgage. As I explained to you earlier, there's a vast difference. Okay? So instead of $8,000 a month, it's now probably, what did I say? A 5%? 5%? Yeah, okay, instead of $7,500 a month, it's going to be $5,000 a month for the same thing. So what happens when more people can afford to purchase an asset? In fact, there's a shortage of assets to buy, but there's also been a shortage of buyers to buy because they can't afford. So there's this pent-up, there's millions of people that want to buy property, but they can't. They might need to, but they just can't. And credit standards are higher too because of of everything. So if mortgages come down and lending standards come down, now suddenly there's millions of people that suddenly all want to buy at the same time, which will be April of next year. But there's a shortage of things to buy. So we have low supply and a sudden spike in demand for all kinds of real estate. So I'm going to make money because I own real estate, right? So you see, like, there's this relationship with interest rates and asset values. If companies have a lower cost of doing business and their sales stay the same, then they become more profitable. The stock market is based on the expectations of future profits. So if you're a company and suddenly you're likely to be more profitable because your cost of doing business has fallen, people are going to buy your stock and the value of the stock goes up. So if the Fed cuts, the stock market goes up. Right? So it's simple. The expected return of a stock is equal to the risk-free, okay, that's the Fed funds rate, or the yield on the 2 or the yield on the 10. They're all related, so you just pick one. It's just a variable. Risk-free rate of return plus the beta of, okay, the expected return for the market, so we'll say the SPX, S&P 500, minus the opportunity cost of just borrowing this risk-free thing, okay? Okay? Actually, I did that wrong, right? This is wrong. Wrong parentheses, hang on. I think it's this, okay? There we go. Simple math, right? All right, what does this mean? If the Fed cuts, the cost of doing business, this is the opportunity cost, right? The cost of doing business in America falls. So every business in America becomes, at some level or another, depending on how much they actually borrow, okay? Every company in America will be more profitable. Therefore, the expected return of the stock is up. So this could be, well, you could pick Microsoft. How much money does Microsoft borrow from banks? Almost none. Do they issue bonds? Maybe. I don't know. But even then, not much. But, you know, how about a company that issues a lot of bonds like GE or Ford? Well, now they can issue bonds at a lower rate. They're more profitable. Or what about a Russell 2000 company that leases a lot of their equipment? Well, that's going to be tied, right? Because when you lease or you use lines of credit, you know, that's akin to a business credit card, right? So anyway, so if that cost of doing business falls, that small Russell 2000 company will be more profitable and the expected return of the stock will go up because their income is flat. So their I is flat. So we fix it, I bar. Okay. But their cost of doing their business, we'll call that the interest rates, have fallen. Therefore, we'll call this profit goes up. Income is fixed. Big I is fixed. Little I drops. Profit increases. And if the stock market is based on future expectations of profits, and they see this interest rate fall, profits go up, then those who own will become wealthier. Okay? Yeah, so on houses, yeah. So if everyone started buying less crap and instead started buying assets, okay, what would happen? Utopia? Okay, I'm not super wealthy, but I'm not poor. I grew up poor. I've been poor. I was poor. I was very poor for a long time. And then you make a transition. Okay? And for the longest time, people would come into my beautiful house. I live in a nice house. And then they would walk in, they're like, what is this, a museum? This place is empty. And your couches are old. You got no artwork on your wall. Where are your TVs? You don't have any TVs. And I'm like, yeah, I don't own any crap. And my couches are old because I raise little children that destroy things. So when they're 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, they just destroy everything. So we're not going to waste our money. So what did we do with our money? Invested it. See, here's the thing. I don't have any money. Wait, what? We have very little money as a family. I think we have 6 months of income saved in a rainy day fund, invested in short-term cash. So you can like, dude, Wayne, cash and a 2-year treasury. It's a money market. Well, that's the same as cash. Okay, I have 6 months of money locked up in an M1. M1. Do you remember M1, M2, M3? Like if I had it locked up in a Picasso, it's not very liquid. That would be an M3. Okay? So you have to understand the different types of money. So anyways, we have it locked up. Okay, that's it. Only 6 months in cash or near cash. And then I have a lot of money tied up into real estate, stocks, and bonds and funds. Oh. Six figures here, 6 figures there. It's just spread around. But it's gone. So the thing is, if I hadn't done all of that, Angel, I could probably go live an Instagram model life. You see me in the Caribbean on a beach and, spending my money. Here's the thing. I don't have any money. I own a lot of stuff, but I don't have any money. So I don't have that kind of liquidity. Like I can't just go to the Caribbean and drop 40 grand. You know why? That would be a stupid thing to do with my money. I'd have to liquidate stuff that makes me richer every day. Right? So in that case, I trade short-term fun for long-term security. So I have all this money invested. On a day like this, I just got wealthier. I can't turn the money machine off. But I'm locked. I'm locked up. And this is normal. Like let's say you are filthy, stinking rich and you're like, I'm going to put 20 million into a hedge fund. They're like, we're going to lock you up. You're like, wait, what? Or you want to become a partner in a venture capital firm. That's going to be locked up. We're talking millions of dollars locked up. It'd be hard to get the money out. It's going to be opaque and all this kind of stuff. So here's the thing. This is what I'm trying to get at. Rich people don't have any money. They just don't. Everything goes into income producing assets or asset appreciation. Okay? But every once in a while, there's a distribution, often a taxable event. But, Donald Trump doesn't pay taxes because he invests all his money in real estate. You don't pay taxes on that. You have a job, let's say you have a 9-to-5 job. You're paying 30 to 40, maybe 50% of your income goes to taxes. Well, it's because by definition, you're poor. Donald Trump might make $10 million on a deal and not pay any taxes at all. Zero. Rich people don't pay taxes that way, but they don't live the same way. There's a different process, and there's a good reason for it, right? So there could be a distribution. Oh, for example, you lived like you were a pauper for 5 years because you took all your life savings and you went to a bank, and the bank said, instead of you putting money in the bank and earning no interest, the bank said, yeah, we'll throw some money into that real estate deal you're doing. You put in 30%, we'll put in 70%. Turns out your 30% is your life savings. The bank puts up 70%. They're the biggest contributor. Cool. But you do all the work. And the bank gets paid no matter what. Okay, great. You take some risk. 5 years goes by and you timed everything beautifully. You bought this property cheap, and suddenly in the last 5 years, the economy came back around, business is booming, all the apartments are filled, rents went up only because you threw some paint on the wall and put some pretty plants. You did the mowing, you did everything. You collected, you did all the management. You worked your ass off and you made no money for 5 years. But now it's time to renew your mortgage. And the bank says, oh my God, son, you did well on this. Yeah, we would like to renew the deal. But the thing is, interest rates have changed. Let's say they went down. It doesn't make much sense, but let's just say this went down. Okay, so now there's this spread. So the value of your property went up. Your income went up, because remember I said the rents went up. And let's say your mortgage went down. You would never get all three things, right? That would be the trifecta. It doesn't happen. But let's just pretend. Okay? So what happens in this scenario? Well, you've already paid down the mortgage over 5 years. So now your mortgage is smaller. But the value went up. So now you get this new valuation. And you buy out your own loan and you put this new loan in. And once again, 30%, 70% is the deal. Great. But here's the thing. You paid down the mortgage for 5 years. Amortization. And the value went up. So there's a spread. The old mortgage went down, and now the new mortgage is at a higher valuation. There's a difference. It could be on a small real estate deal, $250,000. You just put $50,000 per year for 5 years into your pocket on one day. That might be the equivalent of your job, or 50% of your job. You just got it in cash. Huh. Well, hell's bells. So you can pay yourself, but let's say you're a goober. You go out and you buy a Ferrari. Done. Cost you nothing. Whatever. Okay? Or you give it to me, and I'll grow it by $25,000 per year, and in 5 years, your money is doubled. Is that right? No, it's 100. It's up 50%. But what I missed on that, it would be compounding. So you'd make $25,000 the first year, $29,000 the second year, $32,000 the third year, $36,000 the fourth year, $41,000 the fifth year. And then you add that up and boom. It's not bad for 5 years, but whatever. And now in the second case, instead of spending the money, because usually your old Ferrari is not going to go up in value, and $250,000 is not going to buy you a rare Ferrari, you know, that kind of stuff. So you've spent your money on a Ferrari, your insurance is nuts, the maintenance is ridiculous, and it's so expensive you never drive the thing. Okay, great. Meanwhile, if you just put your money in, bought some more assets, now the value of those assets have made money, but you don't have to mow the lawn. You don't have to paint the walls. You don't have to have conversations with ridiculous tenants, right? So you can still own the apartment building, which has probably got, what, a cap rate of 8 or 9, and then over here, I'm trading your money for you, giving you a cap rate of 12. One, you work your ass off. One, I work my ass off. And, you know, at the end of 25 years of doing that, oh yeah, you have more money than you need. And if the government gives you everybody $10,000, then the standard of living for everybody in the economy drops. But they'll spend all that money and I'll own stuff and I will get richer. Okay? You see? So think of this on hell when it comes to money. Money is easy if you're willing to make a sacrifice. If you want to get rich quick, you've already failed, just give up. Dumb. It's just so ridiculous. But if you're willing to sacrifice, it's mathematical. So, let's say you inherit $5,000, right? That sounds like Monopoly, remember? Do not pass go, do not collect $200. Congratulations, you inherited $5,000. Okay, great. You put it, you know, and do you pay taxes on that? I guess you probably wouldn't if it was only $5,000, right? I think after 10 you have to pay. So good, you don't pay taxes. Great. And you put it in your Roth IRA. And it grows at 10% a year on average. Let's just say you're young. It goes up 10% a year on average for 30 years. That's a lot of money. It's a lot of money. I'm telling you. It's a lot of money. It wouldn't change. Your $5,000 wouldn't change your life very much. Oh, really? My great auntie died and left me $5,000? Who? I have a great auntie? Yes. Your mother's sister's mother. Wait, your mother's sister's mother? That's your mom. Your mother's sister's grandmother died. You're like, really? Yeah, you met her when you were 5. At Uncle Buck's wedding. You're like, really? Yeah, she gave everybody $5,000. She doesn't know you. You don't know her, whatever. So you go out and what? Cocaine and hookers, right? Gone. It doesn't buy you anything. Okay, great. But if we have a calculator, and let's see if I can bring one up. I don't really know one offhand. They're all so full of ads, but let's try to do this. Compound interest calculator. Let's see if we can get one. Investor.gov. They're going to ask too many. Nerd Wallet. Cool name. Let's see if it's crap or not. Oh, look, it's even preloaded. 5,000. All right. Initial investment. No contributions. Contribute frequency, it doesn't matter. Years of growth, 30. So you inherit it when you're almost 30 and you're going to take it when you're 60. Compound frequency annually. And we'll make this 10% annually. Okay? You buy the S&P 500 or something. Okay. There you go. That's it. And that's tax-free money, by the way. So when you take it out and you have 90 grand, 90. You turn 5,000 into 90 because you deferred. You deferred your pleasure. So now you're too old to work. That extra 90,000 could go a long way. Imagine you did stuff like this with all of your money. Could you save $5,000 a year? I don't know. So, okay. In my business, I can save $5,000 a month. Okay. Okay. Cool. And little changes can make a big difference. Okay, you see? Now, if I can do it monthly, okay? So I've been farting around, I've been investing a lot of money into your products and community, right? But what I'm getting at is I have 20 years before I'll retire. Okay? And I started the Council of Investment Advisors with 50 grand. It's now well over 70. My original goal was pop in 5 grand a month, but I've been investing into Tradars and QuantBox, and you've seen it, right? And all that kind of stuff. So I'm a little slower than that, but I'll get there, don't worry. And I do this until I legally can, because at some point I have to take the money out. I'm getting 12% right now. So let's change that to 12. Let's say I can keep doing that. I don't know. Okay. So just doing the Council of Investment Advisors. This is a project where I'm teaching people how to construct a portfolio and manage it properly. We have a ton of fun. I'm doing this with real money. People see my real Wall Street account. It's a legal pension fund, you know. It's legally structured. It's just not some account I threw together at a Forex broker or something. Put in real money, and the initial plan for this was I'm going to turn it into millions of dollars of tax-free money. Wait, it's my pension fund. I have to pay money later. Yeah, sorry. I will have to pay taxes when I take it out. Sorry. I have other funds too that are tax-free. So there's like Roth IRAs and stuff like that. This is my corporate pension fund. So in 20 years, I'm just going to put another $5 million in my pocket. But I don't have a nice TV. Okay? I don't go on elaborate vacations. Why? I've been saving money to put $400,000 toward my children's education. I put $100,000 into my education, you know? It's like, I'm poor because I own a lot of assets and I have no money. It's not actually poor, right? It's not really poor. I don't have cash because I'm wealthy. And the difference is, when you're wealthy, you make money when you sleep. When you're poor, you go to work to make money. Which means if you're a lawyer, I don't care if you make $500 an hour, you're poor. Because you have to go to work. So, this account that I'm telling you now that I'm building with the CIA, it made $715 today. I didn't do anything. I made $715. You know, it's not a lot. It's a small account. So some of you are like, dude, I got 10 times more than that. Yeah, so do I. And more than that, right? It's a small account, but it's a real account, okay? And that's the difference. Like at some point, you're not trading your time for money. You see what I'm talking about? You don't trade your time for money. Important distinction, right? And so this idea of where we are. The government and the central bank put too much fake money in the economy. This created inflation. And inflation makes everybody except the extreme wealthy poor. Okay? High levels of income, okay, is bad. You don't want people to have less money. That sounds backwards, right? As Angel says. Well, what do you mean less money for the people? Why is that good? Well, no. That's not what people want. That's not how to interpret it. What we want is productivity. Okay? So when TVs came out, let's say a 65-inch. Now, I remember when plasmas came out, and a 50-inch plasma was $4,000. I know, because a friend of mine bought it. A 65-inch 4K TV, okay, let's say when they came out was $1,000. Okay? But they were selling like hotcakes. There was lots of demand. So orders go out to China. Okay? K-pop. Okay? And Japan. And new orders by retailers are coming in like crazy. So each double their production. Okay? So we put this in aggregate. They all double production. Double production. Okay? So through economies of scale, they have more equipment, they have better equipment, they buy more plastic, they buy more glass, they buy more gold, they buy more copper. And because of that, they get better deals. And, okay, because of economy of scale, the cost per unit, this is the cost per TV, the manufacturing cost per unit, okay, otherwise known as marginal cost, falls by 30%. Okay? Okay, so the next year, the same TV is either, okay, 4K, is on sale for $699 instead of $999, or you can buy a 73-inch. I don't know if the math works, but let's just say bigger or 999. You see? All right. Here's the thing. On Hell, wages went up almost nothing in this period. Okay? But you can get the same TV for less money because the global economy was more productive, or you can get a bigger TV for the same money. Okay? Now, what if everybody makes more money? Okay? This is going to go to, I'll just make up a number, $1,300. That's it. That's it. And then when all the free money is gone, in this case, the stimulus checks, it stays $1,300 because that funny money is still there. Now, the problem with that funny money is it's still in the economy, but where is it sitting? In Jeff Bezos' bank account. So, eventually the government should raise taxes to pay down the debt because they borrowed the money to give to people for free. Okay? Who pays taxes? Rich people or poor people? Well, who suffers from inflation? Rich people or poor people? Do you think Jeff Bezos says, oh my God, chicken used to be 99 cents a pound and now you have to pay $2.50? Holy crap. He doesn't know. So nobody wins on Hell. No, higher wages, more money, is not good. It's not good at all. It doesn't benefit. And I said this 5 years ago. Okay? Poor people were saved by the stimulus check. Sure. And they definitely need it. That is sure. I'm not. Okay? But I said the unintended consequences of this government action is in 5 to 10 years, poor people will be more poor and rich people will be more rich. Well, we had the stock market go up 30% this year. So imagine you were a millionaire a year ago. Now you're a 1.3 millionaire. You're 30% richer than you used to be because you had $1 million in the S&P 500 and you didn't even do anything. And how about people that don't own real estate, don't own the stock market? They're not owners. What happened to them? Are they 30% richer? No. Well, why not? The government gave them money for free. Well, it's gone. Oh. Well, now what? Okay. So, yeah. So, instead of buying crap, if you bought assets, assets that go up in value. So you can buy a car, which is an asset, but if it depreciates quickly, it's not a good investment. Okay? But if you buy a house, if you buy stock, if you buy bonds, if you buy gold, you buy Bitcoin, whatever, if it goes up in value over time and increases your net worth, yes. But does cash increase your net worth? No, it grows at almost nothing. So that's why rich people don't have any cash. It's all invested in assets. Why? Assets increase their net value, their net worth while they sleep. Huh? Okay, you see? So yeah, a shift. So I don't have a lot of toys. Now, you might say I do. Yeah, but then I know richer people that have more toys, right? So you need to kind of transition from having nothing. I grew up with nothing. $5 was a lot of money when I was young. And then I had something. And it wasn't a lot, so I had to risk it all. Okay? And I risked it all in the form of running my own businesses. And I deferred all the lovely salaries all my friends were getting. But I was a young man and I was an entrepreneur and I was calling my own shots and it was great. And I got a lot of cool skills. Okay? It's neat, right? But, you know, instead of acquiring a lot of stuff all the years, I acquired a lot of assets. That's the big difference. And that's how I got myself out of poverty. Okay? So when I was a young man, $700 was a lot of cash. I'm like, $700 is like legit. I mean, have you ever been a commission-only salesman? Right? You're like, dude, $700 is a good start. Like, it's not a joke. Okay? But when you own assets and you have all these different investments and all these different accounts, and all of a sudden, you know, now one of a dozen investments has made $700 today, and I didn't do anything. And, you know, all of a sudden you're like, oh, but you have to defer your pleasure. I made sacrifices. I worked blood, sweat, and tears for decades. Yeah. So you pay down your debt, you get debt free, you increase your cash flows, and then you invest it all into income producing assets. And one day you'll look back and say, oh my God, that actually started to add up. But, you know, life gets in the way. All of a sudden you got kids and dogs and pets and obligations, and these things are expensive. And yeah, but you got to be able to take care of them. But stuff isn't going to make you rich. And it's funny because what you see in the media is the stuff. Okay? Oh, he's rich because he has an Ardemo Puget. No. 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 That's not what makes you rich. No, if you spent money on something like that, you either have like $25 million in the bank, or you made a really bad decision, or you had some asset that bought it for you. So if you own an apartment building and somebody else paid the rent for 5 years, and then you renewed the mortgage, and they're like, oh, well, you know, you keep $50,000 in your pocket, it's a distribution. Okay? Or you flip it, or you don't flip it, but you renew your mortgage on your property, and you took a $50,000 depreciation expense, which means you just keep the $50,000. So now it's tax-free. Think about this. You just depreciated your asset, which is an economic thing. But in real estate, that means it's an expense. It's not a payout. So you just put $50,000 into your pocket. It's tax-free, and you buy an Ardemo Puget. And who paid for it? The renters. But like a wealthy person wouldn't spend money on a fancy watch. Why? To impress somebody? See the difference? Yeah, it's quite a thing. It's quite a thing. So you have to defer your pleasure. And deferring your pleasure doesn't sound pleasurable. Well, having people make less money doesn't sound pleasurable too. But it's the right thing if you're making the right trade-off. More productivity increases the standard of living. More money does not. Okay? So if you buy an apartment building cheap and then you fix it up, you do the maintenance on it, you paint it, you redo the landscaping, there's new appliances, you put some granite countertops on this stuff, more modern floors and carpet. Okay, and people come in, they're like, dang, this is nice. You were productive. You see the productivity? You capital expenditures, you invested money, took over a depreciated asset, and then you invested it into it, and you increased its inherent value. You were productive. You made the world a better place. And this is how society works. And at the end of it, after 10 years, after 15 years, after 20 years of owning that building, you flip it, okay? Or you exchange it. Really, you want to exchange it. So you exchange it and put $1 million in your pocket. It's because you made a smart move and made society better 20 years ago when you were young. This is why you see old people in Corvettes. You're like, what a jerk. Look at that old guy in that Corvette. Who does he think he is? Well, he's smart and he's rich. What are you doing? Yeah. Go, old men! Go, old men, go! Yeah. Right? You gotta fight for your right to party when you're 50. Yeah. Right? So anyways. So that's a little talk about money, I guess. But it gets you like understanding like these concepts. I agree with you. It doesn't make sense on how totally makes sense. What do you mean people making less money is a good thing? Trust me, it truly is. If you do something. I'm not saying, there's some sort of level of dignity in poverty. No, try being rich. It's better. Trust me. Okay? But the trade-off is, right? If you're not going to earn more money, then what could society do? Build more houses. Okay? So, if housing prices are going to go up 20% when we get to 4% Fed funds rate and a 5% mortgage, I believe the housing market will go up 20%. So cutting interest rates is bad, right? No. So then what's the bad thing? We have a shortage of houses. Bro, learn how to build a house and start building. Crank out. We need 2 million houses right this second. But we're not pumping out people that are capable of building houses. We're not educating the people in the right way. Okay? So, how do you fix the problem of housing going up for 20% in 1 year? Well, let's build a couple of million houses. The supply of housing goes up, the price of housing comes down, but everybody gets a nice new house. The value of that investment to society is great. People live in nicer, newer housing. The standard of living has gone up because the house got newer and nicer and more modern, but the price came down relative to the old prices. Okay? So that's what we need. And that's productivity. That's what I mean. Increased GDP. It solves all the problems. Housing prices are too high. build more houses. Hey, China's got a problem. Prices for housing's collapsed. Why? They built too many houses. Oh, man. Okay? The other is a different problem. Japan, you can buy a house in a small town in rural Japan for almost nothing, like literally $5. But let's say, 50 grand USD, 50,000 USD, will definitely buy you a house in a small town in rural Japan. Because there's no people. Like there's just no people. So it's the other way. There's too many houses. Okay? So we need more productivity in America. We need a focused drive. And you want to see prosperity and unity? Okay? They're tied. You want unity? Prosperity. See, that's the thing about capitalism. It doesn't care if you're black, white, Hispanic. It doesn't care about who you pray to. Right? What God do you pray to? It doesn't matter. Who do you make love to? It doesn't matter. Okay? You want unity, you bring prosperity. Prosperity doesn't come from free money and a fancy watch. That's where poverty comes from. So instead, prosperity comes from productivity. Let's all do something great together. Increase the productivity of the entire economy, for everybody must chip in. Nobody gets a free ride. If everybody chipped in, it would be incredible. And everyone would be filthy, stinking rich, depending on their contribution. And not because of the wage, but like your wage relative to the falling cost of everything. Food will be cheaper, housing will be cheaper, TVs will be cheaper, eating out will be cheaper. Just everything. Your insurance will be cheaper. Okay? So you in utopia, and you specifically on Hal said utopia. Utopia is where you don't need any money at all. Let me give you an example. We get unlimited energy. We either bust out so much solar and wind and oil energy or other types of energy, or we invent something new, like we have better types of nuclear power or fission and fusion and this and that. We have our breakthrough. Just imagine a fission or fusion nuclear power that's clean and cheap, and it just produces energy to the point where everybody has enough energy. Like, there's more energy than demand. The price of energy can go to zero. It doesn't cost you anything to power your Tesla. It doesn't cost you anything to heat your home. It doesn't cost anything to have your lights on. We get to that equilibrium of or not even equilibrium. We just get to the point where there's so much cheap energy that it doesn't matter what you use. Okay? Great. So one of the uses now is that you use all that electricity to power the desalination plants so that we can turn ocean water, which is salty, into clean drinking potable water, which then means we can go to the deserts and flood the deserts with water, because we can do it for free. There's no cost because the energy was free, because we have like some nuclear renaissance. So now we put food where there's desert. We grow food for everybody on earth on useless land. We don't even live in the desert. It wouldn't interrupt anyone's life, except everyone on earth can eat food because it's so plentiful, it's free. Okay? Now, we can go on and on and on and on. But you notice, like, when you get to incredible levels of productivity, that you get to the utopia of whatever that productivity is going towards, the cost per unit drops to zero. If I make 10 billion of these coffee mugs, we don't even have 10 billion people on Earth. The cost per unit would be zero. Like, if one of these left my warehouse, would anybody know? Would I file insurance? Somebody stole one of my cups. I have 9,999,990,000. Like, dude, it gets to the point where it doesn't have any value. I have these cups coming out of my ears. So there is a utopia. You pay everybody money, and everybody ends up poor. Think about it. Where did the money come from? We borrowed it. So now the U.S. is another $5 trillion in debt. Everybody is in debt. It wasn't free money. Every living soul in America is further and further and further in debt. You keep giving out free money, we will have high inflation, high debt, and then we will have low credibility, low credit score. Countries will stop lending us money, and we will end in poverty. Like homeless people on the street, everywhere. Yes. Because you can't just have free money. What do you mean free money? Well, money comes from productivity. Okay? When you go to Applebee's, your income turns into the waitress's income, into the cook's income, to the dishwasher's income, to the maitre d's income, to the bartender's income, to the landowner's income, to the insurance company's income, to the lettuce producer's income, to the delivery driver of the lettuce producer's income. Income is 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 income and income. Call that the velocity of money. There is no inflation. You cannot create inflation from spending. It's not about spending, because it just is a transfer from you to me to her, her to him. It's the same dollar bill going around. What do you mean inflation? Nothing's changed. It's just different people are holding the dollar bill. The dollar bill still exists. So how do you create inflation? More dollar bills. So the Treasury can print them, inflation, or the Treasury can borrow from somebody else, but now we have debt. Now we owe them. But you went out and bought a Samsung. So now the money is in South Korea, bro. So now we're just left with debt. And what happens to your Samsung in 5 years? It's gone. What's the value? Zero. So you have a zero value, and we owe somebody the $500 you spent on the Samsung. And every single person in America has to pay for this now. No. High income, bad. Handing out money, bad. It's all bad. But instead, let's fix up our old neighborhoods. Let's invest money into our roads. Let's invest money into our schools and our education. Let's build beautiful parks. Let's have beautiful art. Let's celebrate our differences and not pretend everybody's exactly the same. Why can't we celebrate the differences? We should love each other. We should work with each other. We should work together. That's where the unity comes from. Productivity leads to prosperity. Prosperity together means we all benefit and love who we are and what we are, and we do it together. That's what unity is all about. Yeah. The question is, why don't we do it? I don't know. So there's a long answer to the question, does it lead to utopia, and what's wrong with higher wages? I hope I stirred the honeypot a little bit, and, you know, it's not an easy concept to understand, but it's probably a different point of view and something hopefully you ponder about. Maybe you'll have a conversation with somebody in your life, and you're like, yeah, you know, because I'm not a crazy YouTube person. I'm just crazy, and I'm on YouTube. So there's no political point of view and all that. I've studied it as much as one person can study on the topic, and I think about these things. So that's just simply pure, neutral Wayne McDonald. So I hope it leads to a wonderful conversation with somebody, and you hash it out, and, you know, you gain your opinion as well. Well, thank you, Abdul. That's I appreciate that. I do. I really do. So, hey, are you going to be part of TradeRs? I'm folding in FX Bootcamp, Investor Bootcamp, QuantBox, all into TradeRs, technical analysis, fundamental analysis, performance coaching, video training, all in one spot. I really hope that you are going to be a part of it. See it burned? He has a good one. Yeah, see it burned. And, you know, when we talk about being productive and making the world place a better place, I'm putting a lot of time, a lot of energy. My soul is going into this. Real money is going to this. Multiple teams are working on this. It's not a small feat that's being done. And I do believe we in TradeRs will make the world a better place. I have very, very, very high aspirations. I can see it. Like, people are always shocked when I explain it to them. They're like, oh my God, what an amazing vision. I'm like, yeah, it's happening. It's real. But it's not real without you. You need to be a part of it. You need to be, otherwise it's a dream and a ton of money wasted. If we come together as a community, you can't believe where we'll be in 5 years. I'm telling you. So I want you to be a part of TradeRs. So I hope you stick close. Lots of things are going to happen. Things are changing quickly, but nothing bad will happen. Don't be afraid of the change. Nothing bad will happen, but lots of great, amazing things are being teed up for you. So stay close and be a part of it. Peace on earth. May the pips be with you. May your profits be above average. Hey, click like, subscribe, and all that YouTube crap. Do it for the algo. Thank you. I appreciate you. Cheers. Except my mouse died.